Okay, thanks guys for joining us. And ladies, one thing I like to mention at the beginning of every single webinar is to watch the Long Straddle webinar again. Whether it's this one or maybe another one that I've done, watch it again because the nuances in and around this strategy may go by you the first time. Maybe you're thinking of a question or something along those lines. The second time through, it'll also help you remember it longer. It puts it into your long-term memory, okay? Another webinar, maybe not specifically along the lines of a directional bias, I might mention other things in and around that video that I may not mention in this one, because a lot of times you guys drive this webinar. Throughout this webinar, I am absolutely okay with you guys asking questions. I want to make sure everyone is clear of concept before we move on. So sometimes those questions will drive the webinar just a little bit different, okay? So please try and take advantage of that opportunity and watch the Long Strangle again, okay? But without further ado, I want to get on with this, but I got to mention a couple of things real quick. My name is Eric Wilkinson. Some of you may recognize me from mainstream media for my talking points on everything from economic to geopolitical and market analysis. I started trading in college, actually, with a psychology degree, switched it over to finance, and after graduating with a finance degree, moved to Chicago and started working on the floor of the Board of Trade. So in the last 25 years, I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products and just about all market conditions. And finally, any opinions, news, research, or analysis should be considered market commentary and not investment advice, you guys. I'm going to be talking about stocks that I like to trade that are maybe even in my portfolio. I'm not trying to get you guys to limbing off the cliff or just jump on board with me. At the end of the day, I want to teach you guys how to trade or teach you guys how to swim rather than to swim for you. And remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, you can also follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat. Something that we're really driving right now is our Facebook page. You can find that at ProTrader Strategies on Facebook, where we're releasing all kinds of videos. My daily market commentaries are on there. So check those out because I talk about every single trade I do, when and where I put them on, and when I take those off, whether they're a winner, a loser, or a draw, okay? One thing I want to talk about here, we are doing the Long Strangle, okay? But going into this Long Strangle, I want you to kind of forget that we are setting ourselves up for the Long Strangle, because at the end of the day, nobody walks in to a trading day and says, you know what, today is the day I need to do a Long Strangle and put that into my portfolio. That just doesn't happen, right? What we do is we find a situation or an underlying where we come up with a bias, whether it is neutral, meaning it's going to trade sideways for the foreseeable future, or, you know, we have a very bullish or bearish idea. Well, this one's kind of what we're doing is we're looking at this underlying and saying, hey, you know what? I think that this thing is going to break out, whether it's news or anything else. Wherever you come up with your assumption, you just feel a big move is imminent. It could go straight up and it could go straight down. But the bottom line is we feel it's going to move. We just don't have a real grasp on which direction. So having said that, here it is, the Long Strangle. Basically, you're going and buying an out-of-the-money put or an out-of-the-money call at the same time, all right? Now, I'm not really here to teach you how to build the Long Strangle, okay? I'm not here to teach you that, because if I was, this webinar would already be over at this slide, right? If that were the case, we would be done. You could even just go online and read how to do a Long Strangle. But what I'm here to do is to teach you how to implement this strategy. The reason why you need to know how to implement it, because there's a lot more that goes on with this strategy to increase your probabilities of success than just going out there willy-nilly and buying an out-of-the-money put and an out-of-the-money call. So we'll go into that a little bit. This is, you know, one of the basic aspects of implementation that you're not going to find about anywhere. They're just going to tell you the out of the money. But what I start to look for is that 30-ish delta. And if you're newer to options trading, you're not really sure what delta is, I will probably beat that like a dead horse here as we go along. But just know we're going to be starting this strategy out by looking at about a 30 delta, which, you know, if you're familiar with options at all, a 30 delta has to be out of the money. So we're going to be looking at that when we start to build this strategy right before implementation, okay? But we need to know what some of the rules are to build this strategy in order to implement it with the highest probabilities of success. And some of those things is picking the right underlying. I mean, picking the right underlying is hugely important, especially for newer traders. And even for me, I follow this rule on a daily basis because I don't want to get in illiquid markets. Illiquid markets get more illiquid when we start getting busier, when volatility starts spiking, okay? Illiquid markets don't have a whole lot of eyeballs on there, all right, are in those options. They are probably more concerned about somewhere else. They might put a bid and offer in there, but it is probably not going to be the best pricing. Whereas we know with free market price discovery, when there's a lot of people in there, that we will fall over each other in order to create a better market. We realize that I can't, be 25 cents wide on these things. I'm going to have to be a couple pennies to make a good market. So we want to pick the right underlying, and the right underlying is as simple as really just looking at the option montage and finding an underlying that has a lot of eyeballs on it. So what you do is you go over, and obviously GLD will most likely fit this rule, and this is during open market operations. This is during the day session, you guys. After the market, like we are right now, all of our orders start getting canceled as soon as that bell rings, unless, of course, you have it in as a GTC. But most people are going to allow those orders to cancel. And after the market, then we'll see those expansions in that volatility, all right? The spread between the two bid and offer will get a little bit wider. So what I'm going to be looking at for this is that we will take what the underlying is. So GLD is trading at 141. So any stock that is more than $100, we're going to take this decimal place and just move it 3 ticks to the left. So we would say that we need to have the bid ask on the spot month, which is the one that is about 35 days to expiration, is usually where people start getting into the option expiration. That's where the most eyeballs are generally going to be trading. So with the spot month closest to 35 days to expiration, we're going to move the decimal place 3 ticks to the left, and you can see that we would come up with 14 cents. Okay. Still haven't learned how to get this thing to work, I guess. We're going to basically look at it for, hold on a second. Sorry, guys. 14 cents wide. Move the decimal 3 ticks to the left, 14 cents wide. You can look to the bid ask. You can see that this fits that rule. They're only 3 cents wide. And we're looking at the ones that are just out of the money or at the money, okay? Ones that get deeper in the money, that rule is not necessarily going to apply. And when you get really far out of the money, not a lot of people are going to be out there trading, so they're not going to be making the best markets. But the ones that are just out of the money or at the money are where we're going to pick this rule up from. So over $100, 3 ticks to the left, that is going to be the determination on how wide these markets are. Now, if it is something that is, less than $100, my rule is we're going to be looking at doing something that is less than 10 cents wide to the bid ask. All right. So 10 cents wide is what we're going to be looking at for that market. I'm going to change my pen thing because that's driving me nuts. I'm sure it is you guys as well. But anything under $100, less than 10 cents wide, right down here. If it's any wider than that, you will be able to see when you pull up the volume and open interest, there's not going to be a whole lot of volume and or open interest on any given day on these markets. There might be a couple of contracts or even zero contracts. That means nobody really cares about those options. Stay away from it, all right? When we're trading options, for sure. Okay, so that's picking the right underlying. If it is greater than, if we have something that is greater than $100, then we move the decimal 3 ticks to the left. 1, 2, 3, and then make our decimal there, and that's how wide it should be. So if it's a $100 stock, we would be looking at 10 cents, right? And if it is less than $100 stock, then we are saying it needs to be less than that 10 cents wide on the bid to the ask. Pretty simple. That's the starting point. That will know because we come up with this assumption in XYZ, right? You've been looking at charts or you hear something on the news and you decide, all right, well, that news is actually going to push this in one direction or the other. Some people might take it as good or take it as bad, but you make sure that you know that there's going to be an outpaced move here now. So we need to make sure we have tight markets. The next thing we're going to be looking at is picking the right environment. And in picking the right environment, this is, we need to have something that has low IV percent. So we need to have something that is really low implied volatility percent, okay? And when I come up with percent, implied volatility isn't equal for every underlying, okay? Tesla has high implied volatility almost all the time. Well, but what is like an implied volatility of 50 on Tesla? That's usually pretty low. But if we were looking at something like a utility stock or something like Best Buy, let's say, maybe a retailer, then a 50 implied volatility could be extremely high. All right. So what we need to know is what volatility, that volatility coefficient right now in relation to what this underlying has seen in the past. Implied volatility is a forward-looking implied volatility, which is why we want to use that rather than historical volatility. But what we need to do is look at that underlying's implied volatility where it's been in the past, because it's kind of like a chart where they will stay in a relative range, okay? So when we come down here and look at implied volatility, you can see, yes, we have gotten some expansion in gold lately, but for the most part, you can see that it's going to stay within a pretty tight range. Implied volatility on the high end is 44 here, and on the low end is about 24. I could flip over to say, let's just take a look at even Tesla for that matter, since I mentioned it already. They always have great volatility. But you can see volatility for Tesla is a very low. It never gets into the 30s, but the high is extremely high, and it goes over, to 110-ish, all right? Now, that's why it's important, because what volatility does is it affects the options premium, okay? So although volatility is pretty high for this, yeah, you would expect the premiums to have a lot of volatility pumped into them, which increases those prices. But having said that, if we were looking at this right now, we could see that the premiums in Tesla are relatively cheap from what we've seen in the last 52 weeks, all right? So we need to discern what this number means for Tesla, ultimately, okay? Does that make sense? And when we are going to be doing, I'm going to hit back to this long strangle that we need low implied volatility. Well, that being said, we have to figure out how to come up with this particular number, all right? And to do that, it's actually very simple. We take current IV, so we take the current IV and subtract that by the low IV. And then we take that sum and we divide it by the high IV, all right, minus the low IV. So we take those two sums and divide them by each other. And in that, let's just go back to, say, Tesla. for a second, or any one of those really, to be quite honest. And we will look at Tesla for that. Actually, let's go to something where the math is going to be a little bit easier on my brain today. Let's go back to this GLD trade. So what we have here is a high implied volatility of, say, 18, and the low implied volatility is 8, all right? And then where we currently are is 15. So the high, we have 18, 15, and then 8. So the current is 15 minus 8, and then we said it was 18 minus 8, right? So we take those two sums, subtract them from each other, and we come up with basically 7, I'm going to go down here, 7 divided by 10. All right? So 7 divided by 10, come up with that answer, and we are going to come up with something that is very close to say 14, right? So it is, sorry, that's not right. Sorry, that it's going to be in the 70%, right? It's going to be in the 70-ish percentile. 10 goes into 7.7 times, right? So it would be in the 70 percentile. Now, if you don't want to always do that math, we have the code that goes in here that you can punch in. If I would have punched in all those exact numbers, we would have come up with a better representation of that. But it's a ballpark for what that was. And you can find the exact number here. We have the code, like to put it in the watch list over here as well. So when you're coming up with this, we need to know where we are in relation to where we are in the past, okay? So that's how we come up with implied volatility percent. And we want not a high IV, because that would be pretty high. 100% is high. 70 is pretty darn high. We want something that is low. So picking the right environment on this particular strategy, we want to come up with something that is going to be less than an IV percent, less than a 50 IV percent, okay? All right, for an ETF, you know what I was looking at there for gold, we want something on an ETF. We want that to be a less than a 30 IV percent. And the reason why is because all of those volatility coefficients for the 25, you know, there's 25 stocks on a minimum inside of an ETF. All of those different volatilities for that ETF are going to have a tendency to meld each other out. And that's going to cause that implied volatility percent to need to be a little bit lower. It's very difficult to get it to really spike like we saw there in GLD, but we know at this kind of time right now, we have a lot of volatility in and around those flight to safety kind of ETFs like GLD. So if it's a stock, we want it to be a less than a IV percent of 50, and for an ETF, less than 30. Now, if you are relatively new to options, this is maybe one of your first classes or first time you've really started getting involved with trading options, then maybe go with a less than a 25% IV and then a less than a IV percent of 50, okay? So low risk tolerance or newer to trader or newer to options trading, go over here to this side and start out with that. You know, once you start getting more comfortable, that means your risk tolerance is becoming a little bit stronger. So you could start ratcheting that up a little bit. But don't go over a 50 IV percent for this strategy on the long strangles. Anytime you're buying premium, remember we talked about volatility pumping up that premium. I want to pay as little for this strategy as I can. If the volatility or the premiums are really expensive, there's something completely different that we would want to use for that directional assumption. But for right now, we have an assumption that something is going to expand rapidly and that will cause volatility maybe increase. A volatility increase will help us here. So we definitely want that to happen. And we'll see that on a big move as well. All right. So then picking the right duration. All right, we've done this where we are buying options premium, all right? Now, what happens with options premium is the closer we get to expiration, we see this. This is theta. This is what happens to theta. And it starts out, theta actually erodes those premiums every single day, all right? That premium is going to come out. Tomorrow, all of our options are going to decrease in value by theta, all right? Even if the underlying doesn't move, volatility doesn't change, none of that happens. Theta will eat away, all right? And we used to say theta was the thief in the night that would come and steal your premium, all right? Well, when you are a premium buyer, you don't want that thief to be stealing your money. I mean, yes, you know it's going to happen. It's almost kind of like a tax in a sense. But one thing with this tax is the closer we get to expiration, you can see this line really starts to take off. And inside of 7 days, you know, it is really rapid. So 35 days to expiration and in, we see a massive drop in those premiums. Therefore, we want to get outside of that area and get out the curve on the option strategy. Now, some people, while I'm going through this, might say, well, why aren't we outside of here? Because theta really starts slowing down. Well, again, it goes back to those eyeballs in the market. There's not a whole lot of eyeballs out here, all right? They are all looking inside this area, way inside, all right? So we want to keep our focus where there is a lot of participation, all right? Just so we can avoid a pitfall of paying too much or giving up too much edge to get into this strategy. And then vice versa, when you go to get out, you're going to have to give up that edge again. That will eat away at your yield. So stay away from that if at all possible, okay? And basically, we're going to be looking at, you know, something in this area here for these types of strategies. So we're going to be looking out the curve a little bit so we can avoid this if at all possible. It doesn't mean that we won't have to carry this strategy into that area, but we want to avoid that theta decay in the beginning for sure, all right? So relatively easy to understand there, right? All right, then picking the right strikes. We already kind of talked about this. I gave it away a little bit. We're going to be looking at that 30-ish delta. And the reason why we're looking at that 30-ish delta is it gives us the best probability of success. Delta tells us a lot of different things, and I don't have enough time to go over all of them. But one thing is, delta is the probability that our strike will finish in the money by 1 penny, okay? So we're looking at only a 30% chance of our strike finishing in the money. You might be saying, hey, Wolfman, that is not very good odds, all right? Well, remember, we're on both sides of it also. But the other thing that we used to say on the floor was 2 times delta is your probability of being kissed or probability of touch, all right? So within the time frame that we are trading in that option expiration cycle, like we said, we're going to be out there in the 70 days or so. In that next 70 days, we have 2 times whatever that delta is that the market will come up there and at least touch us. There's only a 30% probability here that it will finish in the money at expiration by 1 penny. Well, we're not looking to stay in this for the life of this option strategy. We want to get in and out of this one relatively quickly, right? Because for one, we want to stay away from that theta component where the thief is really stealing our premium. We want to get in and out. So if we get this to happen, we're going to be able to get out of this strategy rather quickly. And when we talk about like the break evens and, you know, your max loss, your max profit potential, I'm not looking for this to go in, you know, to infinity and beyond when we're trading $100 stock. I'm just looking for a nice big move to happen really quickly and then get out of this as soon as I see that happen. Being asked, 30 delta for both the calls and the puts. Yes, or as close to a 30 delta. That's kind of why I throw that ish in there. It's going to be very difficult to find an exact 30 delta a lot of times. But another reason why we're going to be going into this strategy, looking for low implied volatility, is because if we looked at this strategy, and don't really even look at it being Nike, okay? Just look at it being the pricing here, okay? Is really what I want you to take home from here. And you can see this is like the 62.5 strike and the 57.5 strikes is what the strategy was built on. Now, this was done with only paying about 93 cents for this strategy is what we looked at for this one. So I was able to buy both of these strikes for 93 cents. Now, with that being said, if volatility were to have started to increase only by 5%, you can start to see that my break even here. So when we look at this purple line really delineates where you are in the strategy when you set it up. So for instance, when I set this up today, if I were to sit here with this strategy, you know, I'm kind of right there at break even. I mean, I bought it at 93 cents. I could likely get out immediately for right around 93 cents, right? Give or take 1 or 2 pennies. But what happens is once that volatility expands by only say 5%, we can see that the market would not have moved. It's still trading very close to where we were, but this line delineates, yes, you are already at a profit because that volatility expansion has increased those premiums dramatically. And I'll show you how the premiums are increased here in a little bit too as well. Now, if I were to go over to Lulu, who has a much higher implied volatility, trying to hit those same strikes, you can see the underlying is trading right, we're calling it right around 60. It's 61 for this one, and this one is 59. So, you know, close enough for government work that the pricing is about the same. But if I pick those same strikes, that 62.5 and that 57.5, just to get the pricing mechanism going, it went from basically looking at about 93 cents over there in the last example to now I would be paying $4.75 just to get the same strikes, okay? Now, the deltas are different. Don't get me wrong. You know, the deltas are different. But the fact of the matter is we're trying to look at apples to apples price, you know, the pricing. You know, I don't want to go through Black Scholes with you guys. I would lose all of you right now, all right? What I want to go through is how this pricing all works in relation to volatility, which I could go through the Black Scholes and bore the heck out of you guys. But I don't want to do that. I want to go through it this way because I think that you can see how the different volatility coefficients, and I will beat this volatility into the ground once we pull up this platform, affects the options premium and where our strike location was. If I only wanted to pay 93 cents for this strangle, then where would my strike locations be? Are you kidding me? Look how far out they are. 72.5 and 50. That is a really wide strangle. I mean, what do you think the probability of this being successful is? Yes, you can go to infinity, but why would you want to be buying options that are that far out? Now, that's another reason why we wouldn't want to set this up in high implied volatility. The other thing is that volatility came out rather quickly. This would be a losing trade really fast because think about it. Our premiums as volatility comes out dramatically reduces those values. It's kind of like theta where we saw that theta coefficient where it kind of slowed off like this and then really picked up. Well, what volatility does is volatility will hold off this line, maybe even increase it. Those are premiums. And then when that volatility comes out, it rushes down to catch up with it. It doesn't really go below it, but it rushes out of those premiums. So we don't want to get in here where we bought on this line, you're buying on this line and that volatility comes out. You might still get that big outpaced move, but that volatility is going to counteract the movement of that strategy. All right. So let's take a look at volatility really quick so I can show you a couple of other examples before we start moving on really quickly. So for instance, I'm going to go down here and give you guys an example of something that I would like to look at. So like I said, we're looking at something with less than an IV of 50, an IV percent of 50. And, you know, for an ETF, it would be less than 30. But let's start looking at some of these down here, like Gilead Science. All right, so Gilead Science has an IV percentile of 15. Now, if I go over here to this chart, you can see volatility is extremely low for what, you know, Gilead has seen in the past. Now, what happens if volatility, if I bought this premium down here and volatility expands, even if this underlying just completely went sideways, but that volatility started expanding, then I could actually see me become profitable without the underlying even moving, without even my market assumption being correct. And, you know, one thing I always say is, listen, I am not the best predictor of market direction. You know, I probably get it right as often as the rest of you, which is about 50% of the time. That's your probability of success on picking a directionality that is correct. It's a 50-50. It's a coin toss. Well, then why on earth would we just go out there and buy stocks for one, or sell stocks? Why don't we do something where we can get involved in something that we are wrong, but, you know, all of the things that we brought in on this strategy starts working in our favor and we are able to reach profitability faster. So if I go over here to Gilead, what I'm talking about with Gilead on volatility, that's what this coefficient is here, Vega. And like I said, this 24 means nothing. And yes, I am talking about, we are probably going to be looking at these options out here that we're going to be implementing the strategy, but I'm just giving you examples here of how volatility or Vega affects those premiums. And 24, again, tells us nothing. All right. What we need to know is that 24 is actually really low for Gilead Science. So therefore, I know these options premiums are cheap. Now, volatility tells us that for every 1 percentage point increase over here, so it goes from 24 even to 25 even, my premiums are going to increase by this correlated volatility, all right? And it's a positive number. That's because it's the expectation of 1 point increase, all right? So if volatility increased by 1%, we would see these premiums go from 775 to add that 7 cents in, it would be 782 to add that 7 cents in here, it would go from $1.75 to $1.82 on the bid to $1.87 on the offer. Theoretically, right? So, you know, I mean, it may be 1 or 2 pennies off, you guys, but we are working in theoreticals here. We don't know exactly. We can only assume by all of our rules, kind of like geometry. We have our rules of how things act. That's exactly the same as here. And the same over here as well on the call side. If it increased by 1 percentage point, being going from 24 to 25, these premiums would increase by the corresponding Vega. Vice versa, it goes from 24 to 23. We have a negative value to that 1%. It's a negative 1%. So then we would subtract the 7 cents from that. All right. Buy now for next pre-earnings run up when IV percent will go up. Great question, Banu. Yes. You see volatility, or you expect volatility to expand, then yes, this would be something that you would be thinking, I need to get in there and buy because I expect volatility to expand. But one thing I don't want you guys to get caught up on is the fact that, yes, when you have a big move, volatility will have a tendency to expand, all right? Yes, that is true. But just remember, if that volatility doesn't happen or your assumption isn't right, you could be setting yourself up for a perilous nosedive in those premiums, okay? So what we can look at here is go over here to the theoretical stuff. Let me make sure this is on the right date. So volatility adjustment, let's just say it goes up by 1%. And we can see that pretty close to, that's plus 1% on this. We can see our premiums are going to go up. They're basically hitting this on the mid-market. So they're saying it's going to go from 148, which is probably pretty close to mid-market here, $1.38. It's going from $1.38. Add that 7 cents in. Oh yeah, right here. It's assuming the mark is $1.38, increases by 7 cents. Then that's the corresponding. Here, the mid-market, it's saying it is $1.77.8, increased by basically that 7.3 cents or whatever, and it goes to $1.85. Okay, so you can see the theoretical adjustment in volatility will affect that premium, right? And vice versa. Let's just say, we were talking about that a stock up here. Let's just look at GLD, for instance, and go back here, hit reset on this, and go back to our volatility in Vega. All right, so GLD, we discerned, was pretty high. And when it starts coming out, let's just say it goes back to middle of the road here. This seems like middle of the road-ish in the last several weeks. It goes down by 3 percentage points. That's why we want to stay away from that. 3 percentage points on this, we can see, we can go back over to these theoreticals and do the decrease again by 3 percentage points. This time I'm going to go -3. All right. And hit, they don't like my zero in front there with a negative. -3. And you can see what would happen to these premiums. I mean, that is a pretty dramatic decrease. I mean, I'm losing 50 cents almost over here on that one side, 50 cents there and almost 50 cents on this side. All right. So you would have lost $1 just by picking the wrong volatility. So make sure we want to see that expansion in volatility. And when that volatility is really low, yes, it can go a little bit lower, but you see when you're buying it in that lower area or that threshold, I say you should be buying it. It could go against you a little bit, but you can see it might be 1 or 2 percentage points. We can't help that. But all we can do is set ourselves up for success and try and get that expansion when volatility is at extreme lows. It's going to want to revert back to the mean, all right? And that's what we're trying to capture, is when it reverts back to the mean, which is another reason why I mentioned, go a little bit less on a stock for an IV percent of, less than 50 IV percent. If it's at a 50 IV percent, you would probably expect it to kind of stay around that mean. That's the comfort zone. But if you are newer to options trading, try and go a little bit lower, maybe less than 25 IV percent to get into that buying of premium. Excuse me. Sorry. All right. So there's a lot of things that we can talk about with that. Another one is for the implied volatility. Let's look at Gilead again real quick. Or actually here, I think I got, I want to compare BBY or BBY. All right, so we can see best buys, high implied volatility is usually in the, maybe let's just say it's 59.50 or 59.60. The real low implied volatility is 19. All right. You get this expansion of volatility, rapid expansion of volatility. And this is kind of what Banu was talking about, heading into earnings. If you were to buy this strategy, you can get that expansion in volatility, right? So even though this underlying was expected to stay within this range, or not really expected, we expected maybe an outpaced move right in here. Well, we didn't get that, right? This didn't go anywhere. But, so we were wrong. We were wrong on our directional assumption, completely wrong. But this volatility expansion in premium going from 18 to 50, I mean, that is huge. That's 32 points, right? And if it was, 10 cents, 10 cents a Vega, and we got 30 percentage point move, we're talking $3 on either side, $6 expansion in our premium, right? So if I bought it at, say, $1 or $1.50 or maybe even $2, but I got that expansion of $6 and it didn't go anywhere, well, I was completely wrong, but that volatility I caught right, and I gained $6 in premium for being wrong, but setting it up where I was setting myself up for success. So one of the few things that we can do when trading to set ourselves up for success is to pick the right strategy in the right environment and play it out that way. That's the only way to really get around that 50-50 probability. I've set myself up for success despite the fact that I can't pick directionality by even flipping a coin correctly. I set everything else up correctly to allow myself to be successful. All right. So we could say Best Buy right now is a 47 implied volatility. We can go over here and look at these premiums. They're $3, etc. Go back down to, let's say, something I think Square has really low implied volatility percent. It does, but it's right around that same implied volatility in a sense. So like I said, you can't really say a 40 IV is expensive premium implied volatility. What we have to look at is Square at 40 is seriously cheap premium for Square. All right. No pun intended. All right. So that's why we need to make sure we are looking at itself for that kind of information. All right. The premiums might very well be the same, but what I'm telling you right now is premium for Square is pretty darn cheap. That makes sense so far? Versus, Best Buy, those same premiums are extremely expensive for Best Buy. So we wouldn't want to buy the strangle in Best Buy, but in Square, that this is the time, if you expected a big move to happen, that you would be able to buy premium and get that expansion and volatility. Is everybody clear on that now? So far? So good? Does that make sense? So volatility isn't apples to apples. You can't just look at Vega and say, oh, it's a 40 or, oh, it's a 60. That's got to be expensive. Well, it might not be for Tesla. It might be really cheap premium for Tesla when you're up in the 60s because Tesla's never going to get down to a 40 implied volatility unless they're out of business. All right. So stay away from that pitfall. And that's another reason why you're not going online and looking to see how to build a strategy. Building a strategy is just, picking out of the money. Just as simple as let's buy this.